Chennai Petro is in the news as the company has shown its dominance in the sector with a year-to-date change of 22%. And this is an uptick, but the stock is down about 2.7% or so. Soumeet is joining in to tell you about how this company stacks up against its peers and whether there's an opportunity here. Soumeet?
Well, yes, Chennai Petroleum in the last 1 month has outperformed its peers. If you look at the gains that we have seen in the last 1 month, it's around 19%, while for other oil marketing and oil refining companies, it's anywhere between 7 to 9%. And we are talking about MRPL, HPCL, IOCL, and BPCL. So why Chennai Petro has outperformed in the last 1 month is because of higher gross refining margins. Gross refining margins, if you look at the Singapore gross refining margin, which is the Asian benchmark, in the first quarter has averaged at around $5 per barrel, which is the highest that we have seen in the last 7 quarters, that is since Q3 FY24 when it was around $6.7 per barrel. And so far in the second quarter, it's averaging around $5.1 per barrel. Now, what is this gross refining margin? This is what an oil refining company earns from processing every barrel of crude into usable products like diesel, petrol, ATF and other products. Now, why Chennai Petro has outperformed in the last 1 month? Because Chennai Petroleum is a pure play oil refiner, unlike other oil marketing companies like Indian Oil Corporation, BPCL and HPCL, which also have the marketing segment in their unit. Along with this, Chennai Petroleum produces more of high margin products like diesel. Now, if you look at the production slate for Chennai Petroleum, the average diesel production from Chennai Petroleum is around 50%, while the average of other oil marketing and oil refining companies stands at around 45%, which is clearly 5 percentage points more for Chennai Petro. Also ATF, which is again a high margin product, Chennai Petroleum's average production is around 10.3% of the total production, while for other oil marketing and oil refining companies it stands at around 8%. So because of this also, Chennai Petroleum must have been one of the most preferred in the oil marketing and the oil refining space. Now, why diesel margins are higher? Because the impact of EV adoption is less when it comes to diesel specifically, and also there are supply constraints in the market which have kept the margins for diesel on the higher side. Now, why investors are not preferring oil marketing companies here? Now, one of the reasons is because the marketing business. Now, because of the volatility in the crude oil prices, the marketing business also sees a lot of volatility in its earnings, and that could be one of the reasons. And second is the LPG subsidy losses which have been looming over the oil marketing companies, but not Chennai Petro, given the fact that it is a pure play refiner. Now, MRPL is also largely a pure play refiner, but why MRPL is also not among the preferred? Because it has few retail outlets, which brings in the marketing exposure. Then apart from that, it is relatively higher debt and capital expenditure plans as compared to Chennai Petro, and also the dividend payout for MRPL is lower compared to Chennai Petroleum. And if you look at the GRM sensitivity as well, Chennai Petro clearly stands out with every $1 per barrel rise in the gross refining margin. Chennai Petro's EBITDA increases by nearly 26%, while that of MRPL, IOCL, BPCL and HPCL increases anywhere between 8 to 24%. But given the sharp rally that we have seen in the share prices of Chennai Petro, if you look at the consensus target price, it is largely at par. 773 was the consensus target price, while Friday's closing price was also at around 774, 772, which means the return potential is not much, but that is the case with every other oil refiner and oil refining companies. For IOCL also, the return potential is just 4.5%, BPCL 3.2%, for HPCL it's flat, and for MRPL it's negative 10%. And if you look at the valuations, yes, valuations are expensive. In fact, Chennai Petro is one of the most expensive oil refining and oil marketing company. 12.9 is the 12-month forward PE for Chennai Petro, whereas the 5-year average valuation stood at around 9.8 times, and that is the case with all the oil refining and the oil marketing companies. But Chennai Petro stands out as it is the most expensive oil refining company currently.
Just a quick follow-up, Soumeet, with regard to headwinds for the likes of IOCL, HPCL, BPCL. Would you say that the under-recoveries for the subsidies that has been a bit of a problem, if that gets taken off the table, do you think that there would be a re-rating?
Well, yes, if definitely there's a news. If the news of government making good the subsidy amount comes in, it will be a positive trigger coming in for the oil marketing companies, because it has been weighing on the share prices of the oil marketing companies for a very long time.
Absolutely. Soumeet, thanks so much for joining in. Very interesting takeaways from what Soumeet has just pointed out, why Chennai Petro has been a preferred pick over the course of the last month or so.